to the explainer. I am so pumped to be with you all this morning. Look, we are jumping right into a rapid-fire breakdown of the overnight macro events and the absolute key technical levels that are going to dictate today's trading session. We've got a ton of ground to cover across currencies, equities, and commodities. So let's get straight into the headlines and the market structure driving them. All right, let's dive right into this. Overnight, we literally saw a massive 18-hour diplomatic marathon in Switzerland between Washington and Tehran, and it actually delivered their first tangible breakthrough. They're setting up a deconfliction cell, moving forward on releasing $12 billion in frozen assets, and crucially, getting IAEA inspectors back in. So what does this actually mean for markets? Well, the Treasury's 60-day sanctions window has effectively reopened. That means we could see 1 to 1.5 million barrels of Iranian oil per day flood back into global markets. Traders who were pricing in this severe oil scarcity just a few weeks ago are suddenly realizing that supply can move way faster than the headlines. And at the same time, central bankers like the ECB's Christine Lagarde and the Fed's Christopher Waller have been actively on the wires, urging everyone to just stay calm and flexible.
Now this perfectly sets up our shift in focus for the day. After days of riding this massive geopolitical roller coaster, traders are heading right back to their natural habitat, obsessing over decimal points and economic data. Today's docket is incredibly heavy. It's essentially taking us on a global growth pulse check, starting with morning PMIs in France and Germany and rolling all the way to late-session U.S. Treasury auctions. Midway through the day, we're getting UK services and manufacturing numbers, and then the heavy hitters drop in the afternoon, U.S. PMIs and ADP jobs data.
Which brings us to the almighty US dollar. Despite those softer oil prices and the geopolitical easing we just talked about, reports of the dollar's demise are still greatly exaggerated. The dollar index is showing some serious resilience right now. Why? Because US yields are remaining stubbornly high. The 10-year yield is once again creeping right up to that crucial 4.53 pivot point. And it's not just about inflation or a hawkish Fed. The market is actively bracing for an impending flood of both government and corporate bond issuance. So, looking at the technicals heading into today's forward-looking PMI and ADP data, structurally, we are strictly in a buy-on-dips environment. You want to look for a really solid floor right around 101.89 to hold. But listen, if today's PMIs come in hot, 101.41 is our immediate upside target. Definitely keep this playbook handy when that US data hits the tape this afternoon.
Hopping over to the Eurozone, ECB President Christine Lagarde took to the mic yesterday. She acknowledged the Middle East tensions are indeed slowing growth, but she hammered home one absolutely crucial point. Long-term inflation expectations remain tethered. Her core message was basically to avoid policy panic. But what's really interesting is that her rhetoric didn't give any sort of fundamental lift to the shared currency.
Because of that, heading into today's critical PMIs, you definitely want to maintain a sell-on-rise bias for the euro-dollar pair. Just to give you some context here, the most recent low for this pair was 1.1411 way back in mid-March. But yesterday, the pair dropped straight through its previous support. So that old support at 1.1447 has now flipped to become your immediate resistance, capping the upside along with 1.1483. On the downside, the floor you really need to watch is 1.1388. Okay, let's cross the English Channel, because cable traders got a massive volatile shock to the system yesterday. We saw political pressure completely boil over from within the ruling party, culminating in UK PM Keir Starmer actually announcing his resignation in a televised statement right outside number 10 Downing Street. That sudden political shockwave hammered the pair down aggressively, testing the 1.3150 support before it managed to pull off a pretty smart intraday recovery. Now, even with those UK PMIs dropping today, the overall structural setup hasn't changed a bit. It is very much still a sell-on-rise environment. Keep a close eye on resistance up at 1.3265, but make sure you respect that 1.3150 floor that the market just heavily stress-tested. 161.94. If you are trading the yen, put a giant circle around that number. It is quite literally the line in the sand today. The yen continued its really precarious dance yesterday, briefly testing this exact multi-decade high resistance level that we haven't seen since March 2024. Before finally retracing. Now, technically speaking, this is a buy-on-dip setup down to 160.55, but please tread incredibly carefully here. The pair is definitely overbought, and if we get a confirmed break above that historic 161.94 line, it acts like a trapdoor opening up to a massive 164.60 upside target. That right there is the ultimate danger, and frankly the opportunity, with these multi-decade highs. All right, shifting gears to India now. $515.2 million. Let that sink in for a second. That is the massive chunk of Indian equities that foreign portfolio investors just scooped up yesterday. After offloading over $30 billion year to date, they suddenly turned into really meaningful buyers. This was actually their strongest single buying session since early February. This huge injection of capital, mixed with a really nice rebound in IT stocks and the major energy players, which, by the way, was totally fueled by that softer crude oil we were talking about earlier, pushed the Nifty 50 up nearly 0.4% yesterday. With risk appetite undeniably improving out there, the tactical view is absolutely buy on dips. You can rely on some really sturdy support layers at 23,900 and 23,742 while targeting 24,344 on the upside. But, while Indian equities were flying, the currency actually took a bit of a breather. The rupee snapped a fantastic 6-day winning streak yesterday, slipping 0.4% to close right around 94.68. The US dollar simply flexed its muscles near a one-year peak, and that basically offset any fundamental support the rupee might have gotten from those softer oil prices. Adding a bit more weight to that, expectations of higher US borrowing costs caused forward premiums to rise, with the one-year implied yield jumping a full 10 basis points to 2.95%.
So when we map out the USD/INR, our structural view remains locked on sell on rise. Even with the dollar acting tough, the broader flow dynamics and underlying geopolitics are keeping everything pretty boxed in. Keep your eyes glued to those resistance bands at 94.92 and 95.21 to fade the rallies, with downside targets checking in at 94.51 and 94.06.
And guys, that really brings us to the million-dollar question for today's session. We've just watched an 18-hour diplomatic marathon instantly shift the narrative on global oil supply. But at the exact same time, we have one of the absolute heaviest macroeconomic data dockets of the entire month dropping right onto our desks today, everything from European PMIs to US jobs data. So I'm leaving you with this to figure out your edge before the opening bell. With supply moving way faster than the headlines, are you trading the geopolitics today or are you trading the data? Define your levels, stick to your structures, and go have a fantastic trading session. Thanks so much for joining me on this explainer, and I will catch you all next time.